Welcome back. You're watching Traders Corner, and as always, I'm joined by Garth McKenzie, founder and editor of Traders Corner. Garth, welcome.
Hi, Julieta.
Garth, we are going to venture offshore this week, but before we do, I know you'd like to look at the bigger picture and discuss two charts, being the Dow Jones and also the top 40. So starting off with the Dow Jones.
Yeah, that's right. So we always begin the show just by sketching the bigger picture, looking overseas and then looking at our market. So this week, I'm focusing on the Dow Jones Industrial Average again, like I did last week. Usually we look at the S&P 500 because it's a broader index and it's, I suppose, a better reflection of the US indices. But the Dow is very much in the headlines at the moment because everybody's watching this Dow 20,000 level. And is it going to break and when will it break? So let's join the crowd and look at the Dow and try and make some sort of head or tail of it. What you can see over there is that for the last 5 weeks, it's been stuck in a range basically between about 19,800 and then obviously bumping up against that 20,000 resistance level. And the question is, will it break and when? Now, what's interesting is that this 5-week range that we talk about here it's very narrow range. It's only 1.07% wide. And I mean, and if you add the 0.07%, it's probably accounting for those little tails on the ends of each of the candlestick charts over there. I mean, if you really wanted to say the rump of the trade there is well inside of a 1% trading range, and it's been like that for the last 5 weeks. And just an interesting little fact that that is the longest period ever in history that the Dow has traded in such a narrow range without breaking out.
Which suggests, though, that no one's kind of sure which direction it's going to break out. So it would probably denote uncertainty, wouldn't it?
It does definitely denote uncertainty. Look, obviously, throughout that period, we've been through Christmas and the public holidays over the Christmas period and so on. So that is a naturally quiet time of the year anyway. But I think right now we sit in a situation where we have Donald Trump just days away from being inaugurated as the next US president. And I think we all know that we're in for some interesting times, if nothing else.
If
and maybe
Twitter ran, so anything to go about.
Absolutely, yeah. So let it not be said that the next few years are going to be interesting. But maybe that's also what the market is telling us. There's just a little bit of uncertainty at the moment, and there's no players are willing to make a big bet either way. You know, not going short, not going long. This market is just sort of stuck in a tight range at the moment. My own sense is that, you know, from a pure technical standpoint, usually you would expect a sideways consolidation like that to break to the upside. So you get this rally that we've seen since November, and then the sideways, what really is a consolidation or a correction in time, and usually that will continue in the direction of the trend. But it remains to be seen whether that is the case. Also, what I won't be too surprised if something happens like this, where we actually do maybe dip below the bottom of the range, just to get everyone a little bit nervous and then push out through 20,000 quite violently.
Okay.
My own feeling, I mean, it's purely gut feeling and not based on anything, but is that this market probably needs to end in some sort of a euphoric rise before it all, you know, comes off again. And when you see a sideways move like that, usually it will break to the upside and out. So if you were forcing me to put my neck on the line, I think we will see a break to the upside here.
What about the local market? Because we, in fact, have seen that, and you were quite bullish on the local market. And as you can see by that graph there, it was a fairly violent break up.
Yes, certainly in the last week or so, just over a week, we've seen a very powerful move to the upside on our market, driven by gains in resources shares. But it's actually also been fairly broad-based if you look across all the sectors. The financials have done okay. The likes of Naspers has done very well. Richemont has done very well. So it has been a fairly broad-based rally. This is a chart of the top 40 index, and last week we identified that the market had continued to trade in this downward sloping channel since August of last year. And last week on the show, it looked as if it was beginning to try and break out to the upper end of that channel. But I also said, watch out, there's an inverted head and shoulders here, and it's going to need to take out this 44,500 resistance, which effectively is the neckline of that head and shoulders pattern. And that level is going to need to be breached to the upside in order to open the next leg higher. And if that indeed does unfold, then the likelihood is that that inverted head and shoulders pattern projects up to a target which comes in around about 46,800. And to get a target like that, you simply take the height of the head part of that structure at its broadest point, and then you project that distance up to give you your target. So you can see it indicated there by the green arrow. We're not far off the 46,800 area in terms of that target being achieved. But also do keep in mind we're very, very stretched now on our stochastic oscillators, our RSI as well. So we're in overbought territory. So to expect this market to continue going up at that sort of trajectory is probably not realistic. At some point, it's likely we will see some consolidation setting in.
And is that one of the reasons why your first trade of the year is going to be an offshore trade rather than local?
Yes. Well, look, when I looked at the local market, there wasn't a huge amount out there that was really getting me massively excited about a trade. We're very stretched on our markets. So I was thinking, do I rush and chase this market higher? But cautious about that at the moment. At the same time, I don't want to fight this momentum by going short on anything either. So I've ventured offshore, and we did say on the show last week that we now, for this year on Traders Corner, I've put 100,000 Rand into a local account and 10,000 pounds into an offshore account. And that opens up the world for us in terms of potential trading opportunities, which is great. We've got far more stocks to choose from, indices, commodities, you name it. When you start venturing beyond South Africa's borders, there are so many different things that you can trade. And following up from that, I thought, let's begin the year with an offshore trade. And I did come across this chart of Royal Bank of Scotland, which to me looks very interesting from a technical standpoint. It ticks all the boxes in terms of a long trade. So I've done it, and we kick off the year with a long trade in Royal Bank of Scotland.
I was going to say that it means a lot more homework for you once you do open up your universe to the universe of stocks out there.
Yeah.
So it probably implies a lot more reading, a lot more research.
It does, but it's actually a lot of reading and research I've been doing anyway. And that's also something your viewers can be aware of, is that it's coming soon, we're going to have a service where we provide analysis on the offshore stocks, very similar to what I've been doing with my traderscorner.co.za website, where we look at local markets and local analysis. Something's coming very soon where we'll be providing offshore analysis. So I've been working on the background with that throughout the last year. So it's not really any extra work. It's just now that I'm starting to make it available on the show.
Well, maybe it's just a cautionary tale to viewers out there who are also wanting to look overseas. Got to spend a bit more time reading.
Yeah.
I sound like a school mom. Okay, so Royal Bank of Scotland, why do you like it, Scott?
All right, so mainly the technicals are what got me interested here. Also note that globally banking stocks have been pretty strong over the last little while. The expectation that with Trump coming in, regulation for banks are going to be reduced somewhat, which is a positive for banking stocks. So a lot of the UK banking stocks have been performing quite well. If you look at and Barclays and Lloyds and a variety of others, and including this one, Royal Bank of Scotland, you can see they have been trending up over the last couple of months. And from a technical standpoint, they all look fairly good. So specifically on Royal Bank of Scotland, what gets me interested is that you can see there's this clear upward trend that started in October last year. It joins all the lows through November and December. And now we're seeing the stock pulling back again, back to the support area, which comes in at around about £2.10, £2.15, that sort of area. You can see also that just from a lateral perspective, there was a price swing high in November, which came in at around about that same level. So you've got multiple support zones over here at approximately, I've got it there as £2.13. Also note that your 50-day moving average comes in at that same level as well. And the 50-day moving average has provided support on the last couple of pullbacks. So from that point of view, it looks good. The momentum is up. The trend is up. This is a nice, healthy pullback towards this uptrend support. Also notice on your stochastic oscillator here, you've got positive reverse divergence. Now that happens where your trend for the price is up, but what happens is that on this pullback, your stochastic becomes more oversold than it was on the previous pullback, yet the price is at a higher level. And that's quite a bullish technical setup. Usually it results in a continuation of the rising trend. So be that as it may, I like the setup. I've decided that our first trade of the year is going to be a long position in Royal Bank of Scotland. I've gone long today at £2.18. You can see it's actually 2.1818. When you trade on these overseas markets that are so much more liquid than ours, the share prices can go to 4 decimal points, believe it or not. So that's what we've gone in at, 2.1818. Stop loss is below £2.10, and I'm looking for a move here up to about £2.35 as a minimum, and there's possibility that it goes beyond that area. The red and green blocks there represent the risk to reward ratio on this trade. So the risk is represented by the red block. That basically is the difference between where I've gone into this trade and where my stop loss would then throw me out. And the green block is the reward, where the difference between where I've entered the trade and where my potential target is.
So if you just had to set that, the mechanics as we talk about them of the trade in greater detail.
Yeah, so we follow very much the same principle that we do on our South African account in terms of how we account for the risk and adjusting and calculating the position size. So we'll go through it here. I've gone in at £2.18. The stop loss is £2.10. That means that my risk is effectively 8 pence per share over here. Because we've got £10,000 in our account, I'm risking 2% of that amount. So effectively, it means I'm allowed to risk, or I'm allowed to lose £200 if I'm wrong on this trade, which is 2% of £10,000. All right, and if I take it through the calculation that we always do, I take the capital risk of £200, I divide that by 8 pence, that gives me 2,500 shares, or 2,500 CFDs is what I've bought for our portfolio today. I'm looking for a target of £2.35 here, and my risk to reward ratio therefore is 1 to 2.125.
And Garth, presumably use the IG platform to do this trade?
You can do it through the IG platform, yes, and there are others as well, but yes, the IG platform is the one that we use and the one that IG sponsors this show. And account holders at IG can open an account offshore with IG that is a parallel account to their local accounts, and they can therefore trade the world once they get outside of South Africa's borders.
I mean, I'm asking more than necessarily to punt IG, but just to ask about the prices. Are they materially different to trading costs locally, especially when you're buying CFDs internationally?
Actually, when you go offshore, you'll find that the trading costs become a lot more competitive.
Okay.
The overseas markets are way, way, way more advanced and developed than the South African market is, and for that reason, the competition is much stiffer, and pricing, therefore, has become much, much cheaper. So it is actually quite cost-effective to trade the overseas markets relative to what it costs to trade the local markets.
Yeah. Although I must say, looking at the chart, still looks a bit like monopoly money when we talk about £200. Okay, so that's the first trade of the year. So if we had to look at the portfolio, really that's the only open trade that you've got at the moment.
Well, that's it. So this is how we're going to present the portfolio going forward. Obviously, we've got two components to it. So we've got the local Rand account, which is still sitting with 100,000 Rand in cash. And then we've got our offshore portfolio, which is in pounds. There you can see our long position in the Royal Bank of Scotland, 2,500 CFDs where we long at £2.18. No movement on that at this point. So the account value is still sitting just slightly underneath £10,000. The difference really is the transaction costs that we paid in order to do this trade.
Yeah. And Garth, then to end off the show, you've got upcoming courses. So starting the year off with Bang, courses coming up next month. Yes,
that's right. So in Johannesburg, I'm running an Understanding CFDs course on the 9th of February, and then a high probability trading course on the 11th of February. So anyone that would like to attend either of these courses, please email me, garth@traderscorner.co.za, and I'll send you all the details on both of those courses.
And finally, just to remind people that they can subscribe to the website for a weekly reminder.
Yes, that's right. We've got a nice database growing of people that have subscribed to our free weekly email. If you go to traderscorner.co.za and click in the middle of the page there, you'll see there's a link to a free weekly email. It's very straightforward to subscribe to that. And what we'll do then is send you an email every Tuesday at around about lunchtime detailing what is coming up on the show for the week ahead. Basically gives you a little bit of a sneak preview before you sit down and watch the TV show on whatever evening of the week you choose to watch it.
Okay, we'll leave it there. Thanks as always for joining us. Garth McKenzie is founder and editor of Traders Corner.